3, 2, 1. Right, this session we want to complete the fourth of our 4 quadrants. It's the bottom right quadrant, and it is the balance sheet. It is the bottom. It's not. We finished doing the income statement last session, and just the 2 parts of the balance sheet to be done. There were some matters arising. I was reminded that to tell you that when we calculate our ratios in the top left, there are some times when you're going to get an error because there's no data or something below. And so just like we did further down, and do you remember down here we said if error, we did the if error and we put in a 0. Well, we want to do a similar thing over here. We want to do an if error, and instead of a 0, we want to put double quotation marks. Okay, these are 1 quotation mark, 2 quotation mark, an empty string. We're going to do that because we want the median function, not the one that we use over here. This median, we don't want it to be affected by errors. If there's an error in there, it stops working. So please put that if error, comma, quotation mark in. Right, let's move ourselves down through the income statement that we'd sorted out. There was one piece, row 44, the dividend that we still want to cover. But here we go on to the top part, which are our assets, how the capital has been employed. There are 2 main parts here. The first is the current assets, and those are inventory and receivables and cash. And you'll see that we've linked them to sales. We have a ratio at the top. We've linked them to sales, inventory percent of sales, we have a ratio at the top. And I think the same for accounts receivable, percent of sales, yes, again, times sales. So all of those will grow with sales. A more important one is our long-term fixed assets, what we call PPE, property, plant, and equipment. And those are assets that lasts usually longer than a year. They're not current. We're only allowed to deduct the cost of them over many years, in form which we call depreciation. So we have to start at the bottom here. We have to start with the value of our worn out assets. It's called net property and equipment, this line here, and we link it to us again to our sales. We've got a ratio, an efficiency ratio that says what percent of our sales do we need as assets, as working assets. And that's what we calculated up there. Net PPE is a percent of sales. So that's our linkage. That's pretty easily done. We just multiply by our sales and we've got the number. The next part is a little trickier. Well, let me show you first what we're going to do is these 2 numbers here, which are total depreciation and the net, those must add up. You can see here, I'm just adding them. The net and the accumulated must add up to our PPE at cost. This is the at cost line. So this is our accumulated depreciation. I think it's called that. Yes, accumulated depreciation, top left, yeah? And so we have to accumulate it. So watch this. We have to take last year's accumulated depreciation, which is the 6.66 billion, and we need to add to it. We need to add any depreciation this year. For some reason, there's an if error around here, just in case that goes wrong. We need to add that sounds easy, but we have to remember, and this is a little trickier, we have to go and subtract any depreciation that has now fallen out of our depreciation cycle. So if our depreciation cycle, let's say depreciation was 10%, then 1 over 10% is going to give us 10 years. So this is going to say, please go and subtract out any depreciation that came from 10 years ago, because we don't want it in our accumulated depreciation anymore. So we start with what we had last year, We add the current depreciation, and we subtract out any old depreciation that's past its cycle. And then we add them together. You might not see it here, but our depreciation, which we've calculated here, it needs to know what your property, plant, and equipment is. But down here, you haven't calculated it yet. This line here, you haven't calculated it yet. And you can only calculate it if you know, if you look at this, if you know the depreciation. So here you've got a catch-22, a circular reference, but Excel is going to sort that all out for you. To do that, you go Alt-F-T to get to the Excel options. I'm going to go down to Formulae, and this is where you can set it. I'll put it on manual, and we want to enable iterative calculation. Okay, that's where we turn this on. Enable iterative calculation. So when we calculate, it doesn't have a heart attack. Right, here are a line that is called total assets. And if I press my F2 key, it's very useful that everything comes up in colors. You can see that I'm adding all the bits at the bottom: non-current, investment and loans, intangible assets, total current assets. But the important part here is not to add the PPE at cost, but to add the PPE after depreciation, the net property. Okay. And now our sales that we have forecast is implying that we need assets of 20.5 billion rand. So we better hand this over to the finance department, the CFOs, etc., because we need to go and get some money. And down the bottom here, you'll see that the total money that they're going to get for us, the total liabilities and equity, is the 20,519, and it matches the 20,519 there. And it's no coincidence, guys. It's no coincidence. That has to match. That's your balance sheet matching. So how are we going to do this? We've got things like current liabilities that we have to go and link to sales. Yes, we've got a link to sales there. What about tax? Taxes payable. We've worked out what percent of tax is payable, and we multiply that by the tax we've calculated. We're going to see the other side of that just now. And we've got some debt. This is the short-term interest-bearing current liability as percent of sales. Okay, and if you multiply that by the sales, you are going to get the short-term interest-bearing current liability. Right. So if you add all of those up, you get your current liabilities. Well, we've also got a bunch of things here: convertible debentures, directors and shareholders loans, long-term non-interest-bearing, and long-term interest-bearing debt. Often these are just zeros, but your long-term interest-bearing debt is going to be set to what it was last year, the prior one, and we're going to add some new long-term debt. So you can see a little bit of working calculations in here, and that's our long-term debt. In terms of equity, we've got ordinary share capital, and that ordinary share capital is what grows. If you take last year's common stock, I've called it, and we're going to add the new equity. Do we have a new equity line? There it is. And this year we're adding 0 new equity, so the line should stay the same. It does. The other important piece here is the distributable reserves. Okay, these are distributable because they've been earned on the income statement. So you take last year's value and you add the retained earnings from the income statement. And that's how our balance sheet strengthens itself year by year. What else we got? Outside shareholders, sometimes preference shares, non-currents. The deferred tax we have to worry about. Deferred tax is an interesting one. Let me just zoom this up a bit. Deferred tax. This is always, I think, Shift Control U, and I can show you at the top here. Deferred tax, take last year's value, our opening value, and we want to add to it the percent of tax payable is what we paid out, but 1 minus the percent of tax payable will be the percent of tax accumulated and not paid out. We multiply that percentage by our tax, and that's how our deferred tax accumulated grows. You must remember, though, that at some point your deferred tax will need to be pulled out of that account and paid when a accelerated depreciation cycle expires. And so you're going to need to go and subtract, and it's the same formula, except you need to, in this case, I'm pulling out last year's one, just assuming this is a 1 year difference in the accelerated cycle. So that formula there is the same as that formula there, it's just 1 year different. Good, so we've got accumulated deferred tax. Right now, let's see if I can get this to work. Shift Control U, give me some more space. And if I press Shift Control U doesn't make it come in colors. I don't like that part. So I'm just going to press F2 now and show you how we are going to add up. And we're adding up everything in this year. We've got equity, long-term debt. We've got a whole bunch of these things. 1, 2, 3, 4, 5, 6, 7, 8. I think there are a good 9 different sources of capital. Okay, the most important ones are the equity and the long-term debt, but there are often others. And we need to consider all of them. Isn't it amazing, though, how does it balance? How does it perfectly balance? They're the assets, and there are the liabilities. I didn't see where the formula. The only place that we could grow things was where? It was when we included in here some new long-term debt, and when we included in here the equity, some new equity. So this number here, these debt and equities, which add up to our thing called a new capital required. The new capital required, guess what? It's the shortfall. So if you calculate the shortfall in advance, you can then divvy it up into debt and equity and apply it in the right places. There as debt and there as equity, and miraculously, your balance sheet will balance itself perfectly because your debt and equity now link back to new debt and equity, which links back to your new capital required. This is quite clever. So how do we calculate the new capital required? I want to take you to, this is page 10 in the cheat sheet. And when you get there, go back to page 9. So have a look here. We know that in order to finance our total assets, we can finance them with last year's debt and last year's equity, as well as this year's current liability, this year's deferred tax, if we're not going to pay the receiver, this year's retained earnings that's coming for free from the income statement, and a magical number called new capital required that makes this perfectly balanced. So if you rearrange this, the new capital required is the difference between total assets and all our sources of finance. Remember that it's old debt and old equity, because with this difference that we calculate, we're going to split it into some new debt for the year, new equity for the year, and add it in so that it will perfectly balance. So we see that in action. I'm going to press F2 here. F2, and guess what? Do you remember what did it say? Was it total assets minus old debt and old equity? Look, there it is. Assets minus prior equity, prior long-term debt. Fantastic. And all the rest. And hopefully you've got 1, 2, don't count the retained earnings, 3, 4, 5, 6, 7, 8. I've missed one. 1, 2, 3, 4. Sorry, it is right. It's 9 sources that we must subtract from total assets, and don't count the retained earnings because retained earnings is not on the balance sheet. That's how much we need, and it's the same formula all the way across. Same formula. So looks like we're always going to raise the capital via debt. Well, debt's a good place. It's cheap and it's easy. It doesn't dilute the profits. A whole bunch of reasons. But sometimes, because of a debt covenant, like a debt equity ratio, a limit that we can't go above, we're going to have to raise new equity. And so if I go up to my top of my model here and I put in, I'm just going to choose a number, MXA. I'll force things to go a little bit crazy here. Okay, I'm going to make it 20. There's no ways this company is growing 25%. I want to force it into raising a whole lot of debt. Still doesn't want to do it. 55. I don't know. I just want to make my point numerically here. Right, I give up. That this is good enough. In June 2021, you can see we need 5 billion, and we only got debt capacity for 2.6. The rest has to come from new equity. We're going to actually have to issue new shares and dilute. It's a very bad idea to do that. So how are we going to know how to split it up? We can see that those two numbers add up to 5,670,433, but how did we split them? This is where I'm going to take you to slide 10. So let me ask you a question. Let's start down here with equation B. Our new capital required is going to be made up of some new debt and some new equity. Right, that plus that equals that. But let's calculate and have a look at our max debt equity ratio. That was the final ratio that we calculated at the top of our spreadsheet. And we want to make sure that last year's debt plus any new debt that we raise, when you divide it by last year's equity and any new equity that we raise, and of course any retained earnings that are going to come in, that quotient must be less than our maximum debt equity ratio. That needs to happen. So if we rearrange this, we can pull the new debt out by itself and say new debt must be less than, and here's a formula, but unfortunately you need to know the new equity, which we don't know yet. But we do know that the new equity can be written as the new capital required minus the new debt. So if we write this equation down here again, but we swap out the new equity for new capital required minus new debt, it's still a bit of a mission because the new debt is on the left and the right. But we'll multiply it out and do some algebra, and we can finally show that the new debt must be less than or equal to, have a look at this, our last year's equity, plus any new capital required, plus any retained earnings. That's equity. Multiply that equity by a debt equity ratio, that turns it into debt. Subtract the debt that we currently have, last year's, and then divide it by 1 plus our maximum debt equity ratio. That sort of makes sense, but this is just algebraically correct. We've now got a formula. And just before you go, remember that we don't want to raise more debt than capital required, because that would force our equity to be negative and imply a share buyback. We don't want a share buyback. So we're going to use the min function to make sure that the new debt is not more than the new capital required. Right, memorize that formula quickly. So I'm going back here. I'm going to press F2. And this says only do it if the new capital required is greater than 0. Only do it if you need to. And when you do it, make sure that your new capital required, okay, you min it with new capital required, don't raise more than the new capital. The real formula starts here. Take your debt equity ratio, multiply it by the sum of last year's equity, the new capital required, and the retained earnings from the income statement. That turns it into debt. Subtract the long-term debt and the short-term interest-bearing current liability, and then gear that up again by dividing by 1 plus the debt equity ratio. What's the naught on the end here? This is to say don't do anything if new capital required is is less than naught. So we have a formula. And of course, it's not going to reach in some places, so we're going to have a residual, and that residual says, please take your new capital required minus your new debt, and what's left we must raise as new equity. So all of this should balance out nicely. I'm going to see if I can take this back to 1%. And I'm going to do some tricks now. I'm going to, in one fell swoop, I'm going to reduce the cost of product sold and SG&A by 3%. Yeah, that has a massive difference to our bottom line. And I'm doing this just for fun. So I want to show you that, hey, all that capital required is not there because we've made so much profits that our retained earnings are good enough to drive this business forward. So I've just pressed F9 because I'm looking at my new capital required. I want to show you that it's all negative numbers. And at the bottom here, we're iterating. And you have to press F9 a few times to get it to iterate down to 0. That's good enough. It's so good, in fact, that the new capital required is perfectly 0. Now, notice we've got no debt and no equity, no new debt or equity. So this part of our balance sheet isn't growing. Look, you can see it's not growing. That number is exactly the same. And our ordinary share capital is exactly the same. So how come this is so perfect? Turns out that if you've got negative new capital required, you've got a surplus. And this is the time I'm taking you back up to row 44, which is our ordinary dividend. And you can see that we're paying out a dividend. I want to delete that dividend and recalculate. It takes a while. It's deleted. Let's see if we didn't pay it out as a dividend. I want you to see it now sits there as negative new capital required, as a surplus. We can't have that just floating around. That's a leak on our balance sheet. So to make it work, we're going to do some tricky stuff. I'm going to copy my formula and paste it back in again. And as it calculates and iterates, I'm hoping, there it is, 87,008, exactly the number at the bottom. I'm going to press F2 to show you what's happening here. This line is called dividend in my sheet. And I'm saying only if new capital required is negative, less than naught, should you do this. If you've got a surplus, take your current dividend that's in this current cell and subtract off a piece of the new capital required that we know is negative. So two negatives make a positive, and this piece now is going to grow your dividend. Because you're only doing it piece by piece here, 20% at a time, this number 5 can be 4 or 6 or different numbers. This will eventually pay out more and more dividends, so that when you know that when you pay out a dividend, your retained earnings gets lower and lower. So your contribution to balance sheet gets lower and lower. And eventually it pays out the exact right amount, 87,087. Pays it out so that we perfectly, with that massive formula, perfectly gives you a 0. So we've dealt with two situations. The one where we require capital and we have to go and distribute that requirement through debt and equity on the balance sheet, or another situation where we have got too much capital and we must go and redistribute it via dividends on row 44. I'm going to just remember to go and put this back to 0. We might come here at a later date, but you can see I can go and change my spreadsheet without having to change it. These are those X lookups that we referred to earlier. How we're doing? We're looking good. We're back to needing capital and everything's good. So at this point, I can show you that if I add up all my liabilities and equity and I compare them, I subtract liabilities and equity, I subtract it from my total assets, I get precisely 0. Okay, you can't type in a 0 here, guys. You actually have to calculate it. Okay, and while you're here, you might as well add up your long-term debt and your short-term debt, divide by equity, and see how that compares. And see that your debt-equity ratio truly is below the maximum debt-equity ratio. So we are in very good shape. At this point, you've got an income statement, you've got a balance sheet, everything balances. We are ready. We're ready to start the next video where we're going to calculate projected free cash flow. And the place that it starts is to look at profit after taxes. Profit after taxes is NPAT. And if I go press Control square brackets, it takes me back to that exact row. Row 37, I'm going to pick it up. There we go. And in the next video, we're going to show you how to make all the adjustments, calculate free cash flow, and turn everything into, finally, guys, we've almost forgotten why we're doing this. Finally, we want to turn it into a single number, a share price. I look forward to showing you how to do that in the next video.